Welcome back to Daily Finance News, your go-to place for all your financial updates, insights, and analyses. Today, we're diving deep into the volatile world of crude oil, its recent trends, the role of the U.S. administration, and how you can potentially position your investments to maximize your returns. Let's start by revisiting a statement I made in an April 23 bar chart article. The U.S. administration failed to replace some barrels sold since the massive Strategic Petroleum Reserve (SPR) release began in 2022. If oil prices return to the $100 level, the missed opportunity will become a tragic mistake, as the U.S. will have far less ammunition to combat rising petroleum prices over the coming months. Now, as a full disclosure, I am bullish on crude oil and believe that buying on dips and price weaknesses will be optimal for investors. On April 21, we observed that June crude oil futures had recovered from below $65 in March to over $78. After reaching an $83.38 per barrel high on April 12, the trend turned bearish, and nearby futures were back at the $70 level. Interestingly, this is a sweet spot for the administration. Now, there are two main reasons why crude oil ran out of upside steam. After reaching the April 12 high, NYMEX WTI crude oil futures turned lower, falling back into the administration's $67, $72 per barrel target zone for SPR purchases. The fear of a recession caused by higher interest rates and concerns over the U.S. debt ceiling debate that could cause the U.S. to default on its obligations for the first time were the two primary factors that pushed crude oil lower. Economic weakness is bearish for crude oil, a leading industrial commodity. However, what was the administration's response during this period? They continued to sell. From January through March 2023, the U.S. Strategic Petroleum Reserve was at the 371.6 million barrel level. This SPR fell from 595 million barrels at the end of 2021, marking a 37.5% decline to the lowest level since 1983. This decline occurred as the administration sold crude oil to keep a lid on prices after Russia invaded Ukraine, and supply fears gripped the international petroleum market. The sales were at an average of around $96 per barrel. In October 2022, the administration stated the target to replace the sales was $67 to $72 per barrel. However, instead of buying for the SPR, the administration continued to sell. The chart from the AIA shows the drop in the SPR to just under 365 million barrels for the week of April 28, 2023. For the week ending on May 5, 2023, the crude oil in the SPR continued to decline, reaching 360 million barrels. Now, June could be the magic month for SPR replacement if the market cooperates. U.S. Energy Secretary Jennifer Granholm told Congress that her department could start repurchasing oil for the SPR after completing a congressionally mandated sale in June. She told lawmakers that congressionally mandated sale of 26 million barrels will be completed by June, and it's at that point where we will flip the switch and then seek to purchase. She further stated that the $67 to $72 target will trigger buying when prices are consistently at or below the level. Now, let's talk about crude oil pricing. I believe that the $60 to $70 per barrel level is a floor for this energy commodity, and the risk-reward currently favors the upside. OPEC Plus's last move was to cut crude oil production. Saudi Arabia requires around $80 per barrel to balance its domestic budget. Russia, a leading oil producer, and influential cartel non-member, is funding its war efforts with petroleum revenues. U.S. energy policy that inhibits fossil fuels and encourages alternative and renewable energy sources has, ironically, strengthened OPEC Plus's position and pricing power. Now, if the administration follows through on its pledge to replace the SPR, it could put upward pressure on the price. Moreover, the plans for U.S. buying depend on crude oil's price remaining at the current $70 per barrel level or lower. But what about trading the range? Crude oil may settle into a trading range around the $70 per barrel on the nearby NYMEX futures contract, with a bias to the upside. Over the coming weeks, trading crude oil could be the optimal approach, buying on dips and taking profits on rallies. The Ultra Bloomberg Crude Oil 2X ETF, UCO, and its bearish counterpart, SCO, are two liquid ETF products that seek to deliver a leveraged return on the up and downside compared to the nearby NYMEX crude oil market. But keep in mind, Leverage requires market participants to pay careful attention to risk-reward dynamics, as leverage comes with its inherent risk, time decay. Therefore, price and time stops are the optimal approaches when using UCO, SCO, or any leveraged derivative product. I continue to favor the upside in crude oil. However, a consolidation period around the current level is possible as bullish and bearish factors pull the energy commodity in opposite directions in mid-May 2023. That's all for today's episode of Daily Finance News. Don't forget to like, share, and subscribe for more in-depth financial insights. Stay tuned for our next episode where we'll be diving deeper into the fascinating world of finance. Until then, invest wisely. Outro music.